Coming up in this episode, a national crypto reserve plan that shook the market, China getting its hands on Nvidia's top AI chips, and how Trump's tariffs are driving billions into U.S. manufacturing. Plus, mortgage rates are dropping, but is it part of a bigger strategy to crash stocks and save bonds? And for new investors, we break down dollar cost averaging and when it works best. Stay tuned. Hi, everyone. I'm Gary Brode from Deep Knowledge Investing. We work with hedge funds, family offices, registered investment advisors, and individuals like you to help you get better returns in the stock market. I'm here with our host, Rob Ferry, and he's the CEO and founder of Flying V, our digital marketing partner. Rob, how was your week?
Week was great, Gary. Weekend was great. Golf's into the full swing of the season, so I watched a little bit of the Arnold Palmer Invitational. I'm a big golf fan, so yeah, that was nice, but pretty lazy more or less. My brother had a birthday, went out, celebrated that, and yeah, back into the swing. I know it's been a rough couple days for the market and just in general.
We're heavily hedged, and happy birthday to Tyler.
There you go. Best of both worlds. This week's edition, Gary, of the 5 things we're calling the crash stocks to save bonds issue. So lots to sort through. Crazy week we had last week. Any initial thoughts, Gary, before we kind of jump right into the 5 things?
Yeah, one quick one. I want to welcome new DKI intern, Cashin Crow. He started with us just a week ago today and has already made an impact. For those of you who like reading the written version of the 5 things, Cashin was a big contributor to getting those images and graphs done. And he actually wrote today's thing 5 on dollar cost averaging. He was the one who suggested it. So great start from Cashin, and welcome. And I'm sure everyone will be cheering for him to do terrific work going forward.
Yeah, really good stuff to see the team growing. Gary, we're going to jump right into it. This week's version of the 5 things. Again, the crash stocks to save bonds issue. First thing we're talking about, we're going to go crypto strategic reserve. Nvidia shows up this week. Apple, mortgage rates, and you mentioned it for our educational investment section. Dollar cost averaging today. Gary, thing number 1, crypto strategic reserve. We talked about this a little bit in the past. We're talking the government hodling, but not purchasing. Thing number 1, Gary, crypto strategic reserve set at hodl, not buy. I'll use the other version of the pronunciation, so that way we've got both ends covered. Tell us more, Gary.
That's right, Rob. We are going to need to sort out whether the proper pronunciation is hodl or hodl. And also, just a reminder, we're going with Nvidia this week, not Nvidia. So we've got it all sorted now. But to our crypto strategic reserve, here we go. The U.S. government is creating a crypto strategic reserve, but there's a catch. It won't be buying more. What does this mean for Bitcoin, Ethereum, and altcoins? How did the market react to the news? We break it all down. Stay tuned. So, Rob, last week, President Trump announced plans to create a crypto strategic reserve. The idea is to make the U.S. the crypto capital of the world. He announced the reserve will consist of Bitcoin, Ethereum, and altcoins like Solana, Cardano, and Ripple. The market quickly reacted by boosting the prices of the included currencies. Bitcoin initially surged to over 94,000 and then plummeted down to 82,000 when Bitcoin owners realized, oh no, the new strategic reserve did not include a provision to buy more Bitcoin, and then recovered to 90,000 in a very volatile week. Obviously, what we're dealing with in the market the last few days has been a giant move to de-risk. People are moving out of equities into bonds. More on that later in this episode. But as a result of that, whenever the financial markets go risk off, Bitcoin gets sold, and the apex cryptocurrency has just gotten hammered at the end of the week. That really had nothing to do with the strategic reserve, but it's worth mentioning under the circumstances.
Yeah, Bitcoin definitely over the last couple of weeks been extremely volatile. I think even broke 80, moving in the wrong direction earlier today even as well. Gary, with this, is the government buying more Bitcoin? What are the implications for Bitcoin owners? Obviously, that Bitcoin pricing.
Right. So, Rob, details, the president announced the reserve at the beginning of the week, and details became available at the end of the week. And based on what we're seeing now, the Crypto Strategic Reserve allows only for new purchases. It doesn't allow for new purchases of Bitcoin. And the only way there can be new purchases of Bitcoin is if it's done at no cost to the taxpayer. So basically what they're saying right now is the government owns about 200,000 Bitcoin. That's about 1% of the total supply. And they have that through seizures. Now, they've sold a bunch in the past, and had they held on, the assets they sold would be worth an additional $17 billion. At some point, that adds up to real money. And so what they're really saying is, okay, we have a whole bunch of Bitcoin that we've seized. We're not going to sell it. We're just going to hold it. Regarding the issue of whether they can buy more, that is not clear. So where they said we can buy more, but only if it's at no cost to the taxpayer, that's very specific language. Now, if they wanted to say we can't buy more, they would have just written that. If they wanted to say we're going to use, tax money or government money to buy more, they could have said that. What they said was something that was clearly ambiguous, if that's an expression. Basically, my thinking on it is it's not clear that they're planning on purchasing any more Bitcoin right now. But if they wanted to in the future, the way I deal with that wording, if I were them, is, they can sell assets, sell something like gold, or, they just emptied out a whole bunch of government buildings. They could sell some government buildings and use those proceeds to buy Bitcoin. And in doing so, say, look, hey, taxpayer, it's on the same balance sheet, right? We sold, $1 billion of assets. We bought $1 billion of Bitcoin. There is no net cost to the taxpayer. Now, whether people will buy that or not, I don't know. But the truth is, there's not enough money being talked about here to really make a big deal about it. This is really more signaling than anything. I would just point out that Bitcoin does not need government sponsorship by anybody to be successful. And you, if you're an American citizen, you do not require the approval of any government agency to buy and hold Bitcoin. That is it's a personal matter. And so I don't know that the government matters so much in all of this, but there's a competing idea that's come out of Wyoming suggesting that the US government buy 1 million Bitcoin. So they're talking about, roughly 5% of the total. But even that at current prices, you're talking about roughly $80 billion. Now, if they wanted to buy $80 billion of Bitcoin, it's not going to be at current prices. But the point of all this is whether it's 80 billion, 100 billion, 150 billion, it's just not enough to move the needle on, our massive government expenditures. The truth is, I'd rather see them buying Bitcoin than wasting money on spending. But, here we are.
Moving to thing number 2, Gary, the intro to this is great. We are absolutely shocked over here at DKI that for thing number 2, we found that highly valuable, small, untraceable GPUs were sent illegally to China. It just so happens to turn out that we actually said this was happening in January. Gary, so thing number 2, we're talking China, Nvidia, I did that again. So thing number 2, Gary, China has Nvidia's best processors, something we said in January. Break it down for us.
All right, Rob. Nvidia's most powerful AI chips were supposed to be off limits to China. So why are they showing up on the gray market for $600,000 a server? The truth about export restrictions, illegal shipments, and the loopholes that make them ineffective. Let's dive in. So, Rob, here's what happened. Back in January, when the DeepSeek news came out and rocked the market, and everyone said, "Oh wow, they've trained this, this Chat GPT or Gemini competitor or Grok competitor on, basically $50 million of hardware and $6 million of training expense." At the time, we said, "Nonsense. We don't believe it. This is not what it appears," and we put that in writing. But the other thing that we said is that China has Nvidia's best GPUs. The fact that the U.S. put export restrictions in place did not stop them from acquiring at least, tens of thousands of these GPUs. In addition to that, there was always the possibility that China was renting, use of the best NVIDIA chips on, on foreign server farms, which is something that you can do. The point of all this is, it's really hard to stop this kind of activity. And servers using NVIDIA's last generation Hopper GPUs, which are still subject to export restrictions, are selling for $250,000 in China. That $600,000 number we were talking about before is for the newest Blackwell-powered servers that have multiple NVIDIA Blackwell chips in them, probably 8 to 12 of the NVIDIA Blackwell GPUs in there. That's what you get for $600,000 on the gray market.
Gary, with these export restrictions, I mean, how is it so easy for these Chinese firms kind of evade these restrictions and get around these types of things?
Well, first of all, Rob, there are millions of these NVIDIA GPUs out in the world. And it's worth pointing out, it's not like you got to move something the size of a cruise ship or an aircraft carrier, right? I mean, it's a server, it's a computer, it's a thing that you could pick up in your hands and transport. So, and there's really no way to stop it. When we're talking about something that is physically small, untraceable, and has a gigantic price point on it, like, think about it. If you wanted a $600,000 server, the cost of shipping that box from a third country isn't really meaningful, right? So this was always going to happen. The thing I find really interesting about it is China has a tendency to be very critical of everybody else's ethics while ignoring their own. And, they love to extol their own perceived virtues that, they don't interfere in other countries' affairs, and they're always fair-minded, and they always love to claim falsely that they, observe everybody's, that they respect people's intellectual property. And, what they love to do is, in a very snotty voice, accuse the United States of wrong think and wrong action. And they're constantly telling us to stop our wrong think and wrong action. The fact is, they were told these are not for you. And, they're busy acquiring them in the gray market from third countries. Now, this was always going to happen, and it was unrealistic to think otherwise. But I just think it's really interesting. The Chinese response to this was just to say nothing and pretend it didn't happen.
Interesting developments. We'll keep you in tune with anything happen NVIDIA, China. Moving on, this is the Crash Stocks to Save Bonds issue of the 5 things from Deep Knowledge Investing. Please head to deepknowledgeinvesting.com. Be sure to sign up for a free newsletter subscription. Add your name to our email list. We'll notify you of versions of the 5 things that are coming out, as well as content material being produced and distributed via our insights and research section of the site. Some content material might be paywalled. We restrict that heavily for our premium subscribers. $100 a month gets you access to all content material, current recommendation, buys, sells, unique inside information, conversations, webinars, the whole 9 yards there. So we'd love if you would check that out and allow us to continue to provide this segment, 5 things, on a weekly basis. Moving forward, we're talking Apple, TSMC. Gary, you're saying that this needs to be included when we're talking about discussions around tariffs. Thing number 3, Gary, Apple and TSMC investments, a game changer, you're calling it, for U.S. manufacturing.
That's right, Rob. Apple and Taiwan Semiconductor, TSMC, are pouring billions into U.S. manufacturing, reshaping the future of semiconductor production. But how do tariffs factor into the shift? And could these investments outperform the CHIPS Act? We break it all down. Stay tuned. So, Rob, what's happened is, as President Trump has put tariffs in place, it's created an incentive for corporations to manufacture inside the United States. Recent announcements in the tech field have been unbelievable. Apple has committed to investing $500 billion, that's $500 billion, into research and AI chip production over the next 5 years. That would create tens of thousands of new jobs. TSMC, that stands for Taiwan Semiconductor, they are the world's best semiconductor manufacturer. They make all of the AMD chips. They make chips for Nvidia. They make the best GPUs in the world. It's their Nvidia designs, but Taiwan Semi does the manufacturing. Their plan is to invest an additional $100 billion for a total of $165 billion into U.S. manufacturing to capitalize on already remarkable production efficiency within the U.S. That's going to include 3 new fabrication plants, 2 advanced packaging facilities, a major R&D center, and that will support over 40,000 new construction jobs. Saudi Arabia is investing $600 billion. The Stargate project, which was announced about a month ago, is $500 billion, $500 billion. There are some open questions on the funding for that, but we'll see what happens. SoftBank's looking at $100 billion. So reversing 4 decades of outsourcing is not going to be fast, but this is a pretty good start in just, a few months.
Based on this, Gary, what does this mean for tariffs? Are they working? Are they a good idea? Does that change any positioning that you have there?
So, Rob, I think that's the great question. And the answer, if you're really being honest, is I don't know. And anybody who tells you they do know is being dishonest. We don't know what the effect of all of this is going to be. What I would like to see would be a more honest conversation where people acknowledge the strengths of arguments being made on the other side. So one of the things that I'm seeing is the people who are in favor of tariffs are busy saying, well, this is going to create jobs. That may be true, but they're ignoring the fact that at least temporarily, at a minimum temporarily, there are going to be price increases. We will be seeing some more inflation. And, it is creating a certain amount of stress and difficulty, and it's basically a tax increase. And that's difficult for an economy, a private sector economy that's not doing so great and hasn't been for the last year or two. But the people who are anti-tariff ignore all of the construction we just talked about, all of the jobs. And I just outlined a couple $1 trillion of hard construction and investment in United States manufacturing. We're looking at tens, maybe hundreds of thousands of jobs here. And these should be hopefully good jobs. I think, certainly better than, some of the lower end service jobs. So these are huge benefits. And from that side, they're just saying, well, but, it's a tax increase and it's going to create more inflation and, it's creating trade barriers. Okay. All of those things are true. But the point that I'd like to make is the issue is more complicated than most people discussing this make it seem. And, I had people, I was on Marty Bent's show last week. He was terrific. It was great talking to him about this. And, some of the comments were people saying, wow, this is really interesting. I hadn't thought about it this way. Other people were saying, well, if you're going to argue in favor of tariffs, you're an idiot and I don't need to listen to anything you have to say. Again, just dismissing the point of view. And I'm not really arguing for it or against it. What I'm saying is this is a complicated issue. It's going to take years to figure out if it's possible to reverse 4 decades of manufacturing outsourcing. And if we can do so efficiently and in a way that creates value for the American people. But I would just like to see the people who are discussing this and debating this and arguing this acknowledge the good points on the other side, acknowledge this is a complicated topic, and talk about the benefits and the weaknesses of both sides of this. And that's what we're trying to do here. Basically what we're saying is there are problems with the idea of putting up trade barriers and taxes and tariffs. But the other side of that is if you get a couple $1 trillion of investments and a couple 100,000 jobs and it improves our self-sufficiency, some of these are national security issues too. We can't rely on China for all of our chips. So I just think that needs to be part of the conversation, and it's going to take some time to figure out whether it worked out well or poorly.
Very interesting there, Gary. And like Gary said, if you have agreed, disagreed, let us know. Leave it in the comments. Tell us why. We love the engagement. Yeah, you mentioned Marty Bent too. Had some great discussion in the YouTube comments over on his show. So that was great being on there. Moving forward, we're talking mortgage rates now for thing number 4. We've seen mortgage rates plummet. This is where we get into the title of the issue in the episode. Gary, thing number 4, mortgage rates plummet, killing stocks to save bonds.
Well, Rob, mortgage rates are plummeting, but is the government sacrificing stocks to save the bond market? We break down the strategy behind crashing equities to lower interest rates and what it means for investors. Stay tuned. So, Rob, last week, I wrote an article for the DKI's premium subscribers called They're Going to Kill Stocks to Save Bonds. And that is what's happening here. Basically, as Treasury Secretary Janet Yellen completed her last year in office, she reduced the duration on the US bond portfolio. And what she did was, instead of refinancing 5 and 10-year Treasury securities with comparable new 5 or 10-year Treasuries, she issued like 6-month paper, 1-year paper. And her hope was that by reducing the supply of the 5 to 10-year Treasuries, she wanted to reduce the yield on those securities, right? So if you have less supply, your price would go up. If the price of a bond goes up, the yield goes down. And the hope was that would in turn reduce borrowing costs for corporations and mortgages. That's something that you would like if your party were running for re-election. It didn't work. They didn't win re-election. And we now have a mess. Current Treasury Secretary Scott Bessent has to refinance $7 trillion in the next 12 months. That is an enormous number. So what they're trying to do is, in order to keep interest expense from continuing to skyrocket, the current White House is trying to reduce interest rates even at the expense of the stock market. And they were really clear about this. Both President Trump and Treasury Secretary Bessent were in the press on Friday and Saturday over the weekend telling people, yeah, we're not worried about the stock market. We are going to take some short-term pain. They are talking down the stock market and trying to get money to flow from the stock market into the perceived safe haven of bonds. And what that would do is lower borrowing costs, allow Bessent to refinance for a longer period. And so when you hear the expression crash stocks to save bonds, that's exactly what this means. And as money goes from the stock market to the bond market, from risk on to risk off, that's the reason why Bitcoin is down so much over the last few days. So that explains all of it.
Yeah. Gary, what does this mean directly for the mortgage market, the rates there, just housing market in general?
So the fixed rate mortgage market tends to trade off of the 10-year Treasury. As the yield on the 10-year Treasury goes up, we get higher mortgage rates. As the yield on the 10-year Treasury goes down, we get lower mortgage rates. So in January, Rob, the 30-year fixed rate mortgage average was over 7%. That has since fallen to about 6.6%. It may not sound like much, but that's about 40, 45 basis points, almost 0.5% of decrease in just 2 months. That's a big decrease. That's a meaningful number. And so typically what you would expect to see is, if your financing costs go down, housing prices would go up, except this is a situation where, because we had interest rates go up so quickly a few years ago, a lot of people said, well, wait a minute, I'm not going to sell my home if I have to refinance at higher rates. And so it took supply off the market. What we think is going to happen is the opposite here. If mortgage rates come down another 100 basis points or so, like if they get around 5%, what we would expect to see would be more people who want to sell putting their houses on the market, and we could potentially see an increase in the housing supply. And if that happens, you're going to see lower housing prices.
Makes sense. And thanks for covering that for us, Gary. Again, this is the 5 things from Deep Knowledge Investing, the crash stocks to save bonds issue. Thank you so much for tuning in. Before we move to our last segment, one more time, be sure to head to deepknowledgeinvesting.com, sign up for a premium subscription for access to the entire site. If anything, please just give us a thumbs up or thumbs down. Let us know if you disagree on anything we might be saying. We'd love for you to subscribe to future shows as well, and we'll keep pumping out new content material for really anyone, right? Beginners, intermediate, advanced investors. I think there's something for everybody in deep knowledge investing. Gary, moving to our last thing, and again, this moves more towards the beginner, intermediate, but probably still some stuff, on the other end of the spectrum too. In terms of our investor education and knowledge, we're talking about dollar cost averaging today, Gary. So going to ask you a few questions. What is it? What are the benefits? Give us a real world example. Let's start with that first one, Gary. Thing number 5, dollar cost averaging. What is it, Gary?
All right, Rob. Is market timing stressing you out? Dollar cost averaging might be the investing strategy you need. We'll break down how it works, when it's most effective, and whether it's the right approach for you. Stay tuned. So, Rob, dollar cost averaging sounds complicated. It's actually very simple. I want you to imagine a situation where you find a stock that you want to buy, or maybe forget a particular stock. You want to just put money in the market. Maybe you're going to buy the S&P 500 index or the NASDAQ 100 index, but you're worried that, what if you're buying in at the high? What if you bought everything in the middle of last week, and then, at the end of last week, we got this, huge downturn. Today was a horrible day in the market if you were long. And so that can be daunting to people. They say, how do I know what the right time is? And what if I don't have enough cash right now? So dollar cost averaging is really simple. I want you to imagine a situation where you had $1,200 to invest, but you're worried about the timing. So what you might do is invest $100 a month. And over that next year, you'd get to $1,200. Now, the advantage of dollar cost averaging is you buy more shares when the price is lower. The idea is you're not going to go buy a fixed number of shares every month. You're going to buy a fixed dollar amount. So if you would have bought, if you were buying right now, you'd be buying more shares than you would have bought a week ago. If the price goes up next month, you'll buy fewer shares, the same dollar amount. And so the idea is by buying more shares when the price is low, you can basically reduce your average cost over time. That's the idea. And you're also your returns are less conditional on the level of the market at a particular point.
Gary, in terms of using dollar cost averaging, I mean, what do you identify as the biggest benefits of that particular type of strategy? Who do you think that works best with, right? Or what type of investor would find dollar cost averaging most interesting?
I think dollar cost averaging is best for inexperienced investors. If you're saying, look, I know I want to put money in the market, but I don't know when to do it, and I'm worried about the timing, and I'm nervous I'm going to buy something and it's going to go down 25% or 40%. If you just don't have that level of professional expertise, buying a small amount every month actually tends to work pretty well. It's also great in a down market, so it's really good protection. Now, for clarity, it is not a guarantee of higher returns. So, for example, if imagine like Nvidia stock last year, where it just went straight up. In a situation like that, you would have been better off buying on Jan 1 and just holding it, right? So a situation where stocks are going straight up, you're better off owning from the beginning. But the truth is, nobody gives you that information ahead of time. So it just tends to be best if you're an inexperienced investor to just put a little bit in at a time. The other thing that I would encourage people to do is if you want to invest, but you're worried you don't have the money for it, dollar cost averaging is a great way to do it. And if you don't have $100 a month, you can do $50 a month. If you don't have that, do $25 a month, right? Just start to invest a small amount every month. If you can do it weekly, that's even better. You can do, $25 a week, whatever it is you're able to do. And if you invest like that over a long period of time, chances are you're very likely to do well. And that's why these strategies are powerful. It allows amateur investors to get started at lower dollar amounts without worrying so much about the timing. And that's why this can be effective. It's not a guarantee of better returns, but it's a whole lot better than doing nothing because you're paralyzed.
Great stuff there, Gary. And that concludes this week's version of the 5 things, wrapping up our investor education on dollar cost averaging. Again, if you have any questions for Gary, be sure to head to deepknowledgeinvesting.com, access the Ask Gary feature of our website right there in the top navigation. Send in a question of really whatever you'd like, right? We'll take one, we'll take all, whether you want to talk about investing, Gary's favorite cartoons, pimp mobiles, whatever it may be. You be sure to ask us at any time. So Gary, great episode as always. Would love to turn it over to you for the final words, and thanks to everybody for tuning in, and look forward to next week. Gary, final closing thoughts from you.
Well, Rob, first, 10 points to Gryffindor for working the word pimp mobile into this episode. Thrilled to hear that. For everyone else who's joining us, again, we know your time is valuable. Thank you so much for spending it with us. We're already hard at work on next week's 5 things, and we will look forward to seeing you then. Thanks for watching.
Thanks so much, everyone.